Now, we are joined in Johannesburg by Nadir Thokan. He's an investment analyst with 27/4, and he joins us to look at their 27/4 Asset Select Fund of Funds. Nadir, thank you for making the time to join us. Maybe let's just get you giving us the nuts and bolts of the fund and also the investment philosophy behind it.
Yeah, so all our funds are managed on a multi-management investment process and philosophy. So this fund would be what we'd classify as an aggressive balance fund. It's a unit trust fund, so it would be in the South African multi-asset high equity category, along with funds like the Forward Balance Fund, the Coronation Balance Plus Fund, the Allan Gray Balance Fund, etc. And ultimately, the fund is designed to be a Regulation 28 compliant balance fund, meaning that it can have a maximum of 75% in equities, a maximum of 25% offshore, and all the other rules that go along with Regulation 28 of the Pension Funds Act. So the target return of the fund is CPI plus 7 over a rolling 3-year period. It's really structured to have sort of at maximum 8 or 9 managers in the portfolio, well diversified across asset classes in South Africa and globally, and sort of with the multi-management overlay of in terms of having the most efficient asset allocation to deliver the target return over time, but taking tactical bets in the short term depending on where we see opportunities lie. And then so that would determine our asset allocation along with risk budgeting to ensure that we compensated for each unit of risk we pick up. We must be compensated for a unit or more of return. And that will determine our asset allocation. And then within each asset class, we obviously do thorough due diligence and analysis on the full fund management universe out there, and the most efficient way to blend the fund managers together to ensure we don't have overlap of styles or investment philosophy or overlap of holdings, and ensure we're sufficiently well diversified within each asset class.
Nadir, when you look at local versus international equity, are you fully 25% up with the Reg 28 regulations? Would you have more if you could?
Undoubtedly, I think we would have more. So we are maxed out pretty much at 25% currently. We obviously see our offshore equities and in general is where the best opportunity set lies, both from a relative and an absolute point of view. I think for the last 10 years, offshore equities has really lagged local equities, both in real terms and absolute terms. And, we see offshore companies, generally speaking, have the tailwinds of improving economies, whereas local equities have the headwinds of an economy that's really battling, and the part that is exposed to offshore earnings is really the expensive end of the market. So we see offshore equities, number one, trading at more reasonable valuations, and number two, moving forward, having the tailwinds of improving macroeconomies across the developing world. So maxed out on offshore equities, and if we could go more, we would.
Nadir, when you look at your fund's composition, high in cash, low on bonds. Is that correct?
Well, no, it wouldn't be a high on cash, but high on South African income. So what we would do is that currently, we see very little value in the bond space, with the 10-year being sub 8%. With inflation in South Africa running above 6%, and all the issues we have with regards to our dual deficits, and with regards to rating agencies having us a negative watch or one notch above junk status, we're really battling to find value in the South African bond market at yields below 8% on the 10-year. So what we've done is, instead of having dedicated bond managers within the portfolio, we have made an allocation to income managers who have basically a wider tool set and more tools at their disposal to eke returns out of the fixed income market. So be it playing the FRAs, be it playing across different fixed or income investments, be it nominal bonds, floating rate bonds, NCDs, inflation-linked bonds, maybe a little bit of property. So basically more tools at their disposal to eke returns out of a bond market which we think is fairly fully priced, and with risks on the downside, especially with high foreign ownership as well, with the US tightening monetary policy and foreigners owning 40% of our bond market. So we take all these risks into consideration, and as a result of that, we'd rather have flexible income mandates as opposed to dedicated bond mandates.
Okay. Nadir, reflecting back on the past 12 months, how would you describe your performance, and how do you see that changing in the short to medium term?
I think we've delivered on our targets for the last 12 months. I think there's been a couple of months this year which have been notoriously difficult. January springs to mind, of course, with a massive sell-off we saw in the JSE and the foreigners bailing on our market. So that month in particular springs to mind. But I think the fund's done quite nicely over the recent past to protect capital in a market which has sold off quite aggressively. We're talking about peak to trough. The JSE sold off in excess of 10%. Offshore markets in dollar terms have sold off in excess of 10%, and we've seen the rand strengthen quite significantly in the last 1 month, which obviously would hurt offshore holdings. But despite that, we see the fund up on a 3-month basis when the market has sold off aggressively. So we've seen it protect capital into the downturns. There's been a couple of challenging months at the start of the year, but overall, happy with returns over the shorter term. And moving forward, I think we're seeing fund managers around the country talking down financial markets. We're not going to see the same types of returns from risk assets in particular that we've seen for the last 3 years. We certainly think that's going to be the case, particularly from the top heavy part of the market, talking about the top 40 index. It's difficult to see where earnings are going to come through, given that commodity prices are coming under so much pressure, and given that the rand hedge industrials are trading at the outrageous multiples that they're trading on. So we're looking to extract value from true value cycle ensuing both locally and globally. But certainly not looking for the kind of returns we've seen for the last 3 months. I think on an annualized basis since inception, and the fund is about 2.5 years old, since inception on an annualized basis, we're looking at a return of 18%. That's well in excess of its target. But we're certainly not going to see the same kind of returns we've seen from financial markets for the foreseeable future, given the extent to which they've run up.
Nadir, you mentioned the sell-off we had in mid-October, which was scary at the time, but of course we've bounced back. Do you ever sit down and say to yourself, well, our asset allocation that we've got in place at the moment, based on what the market is now, is going to have to be changed because of basis the market 2 or 3 days later? Because we did see a sharp sell-off. Or is it not as short-term as that?
No, it's definitely not as short term as that, because then we're getting into things like market timing, and that's notoriously difficult to do. We don't claim to be able to time the market. We have a long-term strategic benchmark which we're aiming to beat, and based on quantitative and risk budgeting analysis, there's a certain asset allocation composition which will take us to that target over the long term. So yes, in the short term, particularly we're talking about midway through August, things got pretty hairy when the market was selling off. But we've seen bounce backs from that period, and the message we preach to our clients is that if you're going to be in a high equity balance fund, you can't have an investment time horizon of a couple of months or a couple of weeks. You really have to have an investment time horizon. We're talking of 3 years plus, and on a 3-year plus view, we're not going to be changing asset allocation on a weekly basis when there's a bit of volatility in the market. But having said that, over the last 6 weeks, we've probably trimmed back equities a bit. That's probably been a wise decision. Equities were probably sitting at local equities at 50% of the portfolio 6 weeks ago. We've trimmed that back down to about 42% of the portfolio, and that's really because of the PE multiples. The starting PE multiple that we were on six weeks ago doesn't bode well for financial asset returns on a 12-month view. And that started to pan out a little bit, but we still see value in equities relative to bonds, and as a result of that, will still be the predominant asset class, but seeking to extract returns from a true value cycle ensuing, and the valuation gap on the JSE closing, rather than from the top 40 stocks, which was the darlings of the market for the last 3 years.
Wayne, let's get your final question.
Yeah. When you look at your fund, South Africa's got a culture of let's call it single manager adoration. They love single managers. How have you found your fund as a multi-managed fund has been accepted in the market?
Yeah, I think the multi-manager approach is definitely gaining traction in South Africa. I think if you look at the unit trust space where this fund falls in, you have 200 general equity funds, you have 50 bond funds, and you have thousands of offshore funds. I think for the average investor or for the average financial advisor, that universe is really, really daunting. And they need people who can do research on those funds, and number one, and research on appropriate asset allocation strategies, and that's really really what a multi-manager brings to the table. Being able to due diligence and kick the tires with all those managers that an average retail investor doesn't have the time or doesn't have the expertise to do. And, you know, we all know that asset allocation brings 90% of your returns to the table. And, you know, that's really what we specialize in, bringing the appropriate asset allocation strategy to the table.
Nadir, thank you for making the time to join us. And that does bring us to the end of Investment 360. A very big thank you to Nadir Thokan. He's an investment analyst at 274.